So, gang, we're going over this, gang. We're going over the news. We're going over what just happened. Again, if you're just, just coming to the channel and you just found this out, Ukraine was attacked again by Russia troops, by Vladimir Putin and Russia. Troops attack Ukraine, plant base, nuclear plant base, and are actually took control over Russia, took control over Ukraine nuclear plant base in Zaporizhzhia. I believe that's how you say it. It has took control over it. Russia has took control over Ukraine nuclear plant base. So we're going over this. We're going over the news, gang, so we can be aware of what's going on in this market. All right, gang.
He's this excellent expert at looking at full faith and credit and sovereign dynamics. Priya, what does your world say this morning about where our balance sheets and where our financial system is heading?
So the rates market, the fixed income market, is extremely concerned about what's happening. I mean, clearly there's uncertainty. Political risk, I would say, is always hard to price in. You've got binary outcomes. We're also worried about credit losses. How much of this is going to spill over into balance sheets, as you talk about, for banks, for corporates. And so I think the treasury market's reacting in a classic flight to quality, safe haven type move. But I think the Fed is setting up here to hike as well. So I think the market pricing in this policy mistake. There's also this concern that the Fed is concerned about inflation. We're living through another stagflationary shock. And is that going to make the Fed overdo it? So that's why I think we see the market pricing in cuts a year from now, which I think is really this policy mistake of the Fed. That's also
dovetail your work with Mark McCormick. He's been wonderful on strong dollar, resilient dollar, where the events have shown him to be very correct. We have Euro Swissy at a precipice. We have 2-10 spreads screaming a vector to recession. Link those two worlds together.
So I think what the market's worried about is that the Fed has to respond to inflation. And, as much as they want to be humble and nimble, if inflation's that high, they don't have tolerance for inflation being that high. Do they raise rates? That's going to tighten financial conditions. Plus, we're living through the war also tightens financial conditions. Strong dollar tightens financial conditions. And the impact of financial conditions on the economy is what is very hard to measure. So what the market's saying is that the Fed may overdo it. But I would actually caution the market a bit on that. I think we're absolutely going to get a few hikes. But can the Fed pause once they get rates to 1%, 1.5%? We're actually arguing that the Fed is going to pause at that point and reassess and really see if the economy is responding to financial conditions. And they might be tolerant of higher inflation as long as it's sort of decelerating. And you talk about this jobs report not being that important, which it's not for today. Absolutely agree. But I would watch participation. If that starts to rise, that's some sign that labor supply is picking up, and that's going to bring some downward pressure on wage inflation. So it might allow the Fed to be a little bit more nimble in terms of pausing and preventing this policy mistake that the market's starting to price in.
Priya, this is very similar to what Eddie or Denny was arguing yesterday, that it's actually not as terrible as people think for equities, perhaps other things, but because the Fed is not going to necessarily commit a policy error by raising too quickly, we will all have to tolerate a much higher level of inflation for a longer period of time. What does that mean for the long end?
So it means that real rates, which would probably rise, we do have them rising from here, probably not as much as what we saw in the last cycle. I think it also means inflation expectations are a little bit higher. So I think the long end, when you're talking about, I think you're talking about the 10-year, the 30-year, can it rise as break-evens or inflation expectations stay high, which I think they will. So I think real rates might be lower, but I do think nominal rates are likely to rise from here. But are we getting to 3%, 4% on the 10-year? I don't think so, because I think there's going to be a self-limiting aspect to how much the Fed can tighten, because there's a lot of other tightening that's happening from other areas.
And Priya, to that point, taking a step back, the reason why we're not focused on the jobs report is because we're focused on that stagflationary shock that you mentioned earlier. How much has this environment gotten away from the Fed? They have missed their window to make an impact on this market, and that it's really going to be dictated by how much the price of oil is, by how much the price of wheat is, aluminum, and other commodities.
So I do think, there's the stagflationary shock that you talk about in food and energy. But I think what the Fed's focused on is service inflation, which tends to be more trending. And I think that's really what's going to drive how much of tolerance they have. If that service inflation metric starts to taper off, I think then the Fed can be a little bit more tolerant, because we've seen energy price increases, food price increases in the past. The Fed has looked through it, because ultimately it does start to hurt the consumer. And so I would watch that service inflation, wage inflation. That's where I'm a little worried. If that doesn't decelerate, the Fed may have no choice but to continue to tighten, because and then it works through the economy. It's going to slow aggregate demand. But I would watch that service number really.
Priya, thank you. Priya Misra of TD Securities. The focus obviously on what's taking place in Ukraine right now, but next week CPI is going to be a reminder stateside that the Fed's got a job to do. 7.5% was the previous read. I'm going through the new estimates. The TIGS this time coming at 7.8 for next week. Scott Brown at Raymond James looking for 7.8. Morgan Stanley looking for 8. Thomas Kosberg, a friend of this program, looking for 8.1. Michael Gapin of Barclays looking for 7.9. These are big numbers, Tom.
They're up there, and what the big numbers are as you move out again. I'm going to go to, I believe it's the May 4 meeting. I'm sorry, John, I haven't memorized it yet, but I'm going to go out to the May 4 meeting where this was going to be transitory, or it was going to ebb away in June, July, August. Says who?
Got a median estimate then, Lisa, of 7.9. Now, you tell me, if we get an 8 print, an 8 handle, does 150 make sense on a 2-year?
Well,
149.
but you said a really important point earlier, which is when you start to get a shock from commodity prices, that actually eats into discretionary spending. That's disinflationary. So if you have that kind of backdrop, does the 8 handle even matter if you're looking at a scenario that's moving so quickly? And I think that a lot of people are grappling with that right now, which is the reason why yields are where they are.
It'll be hard to ignore it on March 16th, that's for sure. They'll want to ignore it. I'm sure they would love to, Tom. They can't ignore it anymore.
I'm looking at the Bloomberg Financial Conditions Index, folks, which is legit math. Good morning, Michael Rosenberg and his team. And John, I'm sorry, it shows a tightening Lisa's talking about.
Payrolls an hour away, 423,000, the median estimate. The previous read, 467. Our attention is not on that. It's on the war in Ukraine. From New York City, for our audience worldwide, on TV and radio. This is Bloomberg surveillance with futures down 1% on the S&P, yields lower by 6 basis points to 177, and crude through 110 up 2.5%, and euro dollar south of 110 at 109, negative 0.9%, a weaker euro. This is Bloomberg.
So again, we're about to go into payroll. We're going to go more into payroll. Like I said, this is really about Ukraine and how it's affecting us globally, as prices is about to go up, as the feds and the banks have to fund this war as well. They're going to help with the United States in funding this war. So with, Ukraine, that has to happen. With wheat, wheat has been going up. We've seen oil been going up, gold has been going up. So, different commodities, as those are all commodities, has been going up, as well, So that has a lot to do with, what's going on with, Ukraine and Russia with this, I guess, this war that's going on. We're in a war, and we're watching this, and we're seeing this, as well. The United States, we're seeing this as well. So this has to affect us as, in this market and trading in this market. And we have to go over this as we trade in this market and we make money in this market. We have to go over this game. So in our next video, we're going to dive in a little bit more into this game. And, we'll talk more about this in the future. All right, game.